there. Maybe it's somebody we haven't met before and we're doing meet again. It's cool. Nobody likes 3-letter agency names, right?
Well, I used to work for the Assessor, Recorder, County Clerk for
Oh,
close
well,
on
then
30 years if you count the consultancy.
I better get my information right today.
No, this proposition is new, and that's why I mean, besides being a Farm Bureau fan, I wanted to see what this was all about.
Great. Well, I want to thank Hannah, Bay, and Katie for their invitation and making sure that the Farm Bureau members have the top-notch cutting rate information on property taxes and making it easier for farmers here in San Diego County and in California. So some of you know my boss, Ernie Dronenburg. 2 great things happened in 1978. He was elected for the first time, and 2, Prop 13 passed. So I'll let you decide which one you like better. This year, something that's going to be important during our discussion is he's the president of the California Assessors Association. That's all the 58 county elected officials that are assessors. He authored the Taxpayer Bill of Rights. He's a veteran and also a flower farmer. He's one of your membership. He's one of the members of the Farm Bureau. And for those of you that are on the call that are not a Farm Bureau member, get it together, join. Okay, I'm Jordan Marks. I'm the taxpayer advocate for the office. And Sandy said she worked at the assessor's office, but my office was not here probably when she worked here. And when Ernie came, he said, we need to do everything we can to ensure fairness, provide education and correct issues and make sure you're taken care of. So he created the office and brought me over, and I worked at the Board of Equalization, which audits the assessor's office. So I hope I'm well poised to be of assistance to you. And I'm a former Assessment Appeals Board member. We have 5 offices around the county, brand new one out in Santee with the archive, 415 staff, $80 million budget. And just a reminder of what we do, because some of our other services may impact you. We are the assessor's office, so we appraise all real estate for property tax purposes. Also, did you know we do the penguins at SeaWorld? That's the better part of the job. We also do planes, for those of you that are flying items over farms, and we also do boats. We are also the recorder office, birth certificates, death certificates, marriage certificates, and recorded documents. Those are liens as well as your refi that you're probably doing right now. Record high non-refis coming through. Also, we're the County Clerk Commissioner of Civil Marriages. So Ernie authorizes marriages in the county. We issued 24,000 licenses last year. I bet a bunch of those were farm weddings, rented out your farmhouse. And we actually performed 11,000, almost half of those weddings ourselves here at the office. So if we can help you with your property taxes, your records, and only the civil marriages, we don't do the uncivil ones, then we're here to help you out. It takes about 7 weeks to get a license now. So it's amazing. Sometimes these 20-year-olds forget to get a license. Now, Katie got a license recently, and she did not forget, right?
It was Taylor, but yes.
Oh, Taylor, sorry. Taylor got a license. But even during the pandemic close down, we got delayed a little bit. If Katie needs a license, don't let me know. Just we're going to take care of you. So whatever we can do for you and your family, we're here to help out. We believe in top customer service. We return $3 million back to the county annually. We make sure that our services are open to meet you during 9 to 5. It used to be less, actually. We expanded to make sure you get the best services. We're doing more online, less paper, and we're innovating in many ways. Most importantly, we proudly reduced your fees. So it used to be $2 for every page on a document. Now it's $2 for the first page and 5 cents for each additional page. I know that doesn't sound like a whole lot of change, but if every part of government saved you a nickel or $1.95, you'd be in a better place. Trust me on that. So we're here to help save you money. Just wanted to give you a heads up, and this is going to be part of our discussion today. This last year, we had the highest recording year in 10 years since we've been tracking. Almost 1 million documents recorded. We usually do 600,000 to 700,000 a year, so we're busy. And trust me, during COVID, it has not made it easier to get these documents recorded, staff shortages and whatnot, you can imagine. So we had to move our recording deadline from 4 p.m. to 3 p.m. I know that doesn't sound like a whole lot, but it made it that our staff could leave before 8 p.m. at night. The second thing is, FBNs, vital documents, birth certificates, and death certificates. It's taking a little bit longer to process these days. So the reason I'm mentioning that is because a lot of you are applying for COVID relief grants or different items that you need, your fictitious business name, or you're just trying to get your kid registered at college so they can get off your couch. Haha, they're not going off your couch this year. But if you need some of those documents, feel free to call me. I'm gonna drop my cell phone, email, and Katie, if you want to drop that in the chat box, you can drop my cell phone and email. I'm available 8 a.m. to 7 p.m. I used to say anytime, but I had a 1-year-old and my wife's a divorce attorney, and she said, if you have phone calls coming in after 7 o'clock, you're gonna learn what I do for a living. So let's just keep me a happy man so I can help you. All right. Just another example quickly, when COVID hit and 58 counties were told to shut down their marriage services and other services, San Diego County was the only county in the state of California that found a way to stay open for every service, including marriage services. On marriage services, 57 other counties shut down. We took over a snack bar, we opened up outdoor services, and we spaced them out, and there were 1,700 couples waiting to get married that we were able to take care of. That's just an example of our dedication during the pandemic to you and your business. All right, now let's get into how this is going to impact farmers. Now, in order to understand Prop 19, you have to understand our current property tax system. One, Prop 13, when it was passed, was an agreement between you and the government that said, hey, when I buy this property, I can afford to pay 1% of that purchase price, or we generally say that's the assessed value for the most part, most transactions, and that will be my value, and then that base value can go up 2% per year. That's the cap. Now that you all know how Prop 13 works, you are smarter than 99% of the people out there. So you agreed 1%, that's what you pay in property tax plus bonds and indebtedness. We didn't include that because a lot of calculations. But also it can go up to 2% of that per year. This is what it looks like visually. You bought a place for $450,000, your taxes are going to stay on that black line, even if the market goes up to $600,000, or that would be $1,500 more a year in taxes. You get to know I'm predicting, and you have consistency in your property taxes. Now, the other thing, after Prop 13 passed, they said, what if my taxes go down? Do I get relief? And the answer was no. So then they passed Prop 8, and it says, if the value of your property goes below your assessed value, remember that purchase price plus 2% per year, we can reduce your property taxes temporarily. And when the market comes back, that's where that star is. We will return your value, but never to exceed that 2% limit of increase per year, that cap. That's your protection on affordable and predictable property taxes in the state of California. Also, something that you're going to need to know is when you're making your decision of value, you're going to need to know your assessed value, right? Well, what is my base year plus 2% per year? If you go to your property tax bill, you're going to see right there your land and improvements. Everybody, this is going to impact primary residences, so we're going to include that homeowner's exemption. I'll talk about that more later. But that number where the gold arrow, that's what we're talking about. So on this property here, $252,000 value, the property taxes that based on 1% are $2,529.93. If your property is worth $1 million, you'd be paying $10,000. These are the numbers that we're going to be working with. This is where you start to find out what your factored base year is.
Hello, my meeting, dude.
So in 2020, the California Association of Realtors passed Prop 19. It had a really pretty name attached to it, the Home Protection for Seniors, Severely Disabled, Families, Wildfire Victims, and Natural Disasters. It impacted 4 primary areas that I want you to know about. 2 of them are of concern that are going to most impact you as family farmers and homeowners. The first is the parent to child transfer. That's pretty much what it sounds like. If you have a parent are transferring something to your kids. And then another proposition 193, that's the grandparent to grandchild. And you're like, well, if I can transfer to my kids, can't I just give it to my grandkids? And the answer is no. Your kids must not be alive. So I know there's a lot of grandparents on this call that love their grandkids, not their kids. I'm not telling you to go out and kill your kids to do it, but you have to transfer it to your kid and then to the grandkid. It can't go directly to your grandchild, or you will not get the benefit unless unfortunately your child has passed. Okay, any questions about that? And we're going to take questions as we go along. Use that mute, unmute button. I just don't want to hear about you ordering a late snack or a coffee latte without getting me one from Starbucks, okay? The second,
Jordan, like, quick question.
yes,
The
wanna tell your
could
kid
you
to get away
clarify
with-
on Prop 13? The 2%, that's an annual amount, or is there a compounding, a daily or weekly or monthly compounding?
it's an annual amount released, and we don't know what it is, but it's based on the California Consumer Price Index. So
Okay.
for example, this next year, because of the depressed market, and it's based on gas and eggs and milk and a couple of mixture of items, the increase is going to be 1% this year,
I
not
just
the
meant
full.
the cap, the 2% limit. If
Is
it's
a cap,
just a
right, so-
fixed 2%.
Yeah, so this next year, we're only going to be going up 1%, not the full 2% potential.
Cool, thank you.
Great question. The second area that we're going to talk about is the senior exclusion from reassessment, and that's Prop 60 and 90. Other areas impact, and I just want to let you know what they are, because you know what? Sometimes you're out on the family farm and you lose some body part. I don't know why, but Ernie told me things happen on the farm. And so we have Prop 110. If you become severely or permanently disabled, a lot of our veterans, unfortunately, returning from Iraq and Afghanistan, they can take advantage. If you have a doctor's note, somebody got allergies really bad. I guess they were allergic to somewhere along the 8 near Tecate on the way out there. They were allergic to the sand and they had to move towards coastal area. We were able to transfer their bases. So if you're severely disabled or permanently disabled, you can argue, or not argue, but our office will work with you and a doctor to say, hey, they need to move from a 3-bedroom house to a ranch style house. Great. We'll help you move that basis over. Exactly what we're talking today. And then also disaster relief. If you lose your home to a fire, wildfire, it used to only be that you could move in the same county or to another county that had what was called Prop 171. Prop 19 makes this statewide. Unfortunately, when you had 5 years to rebuild, now you have only 2 years to rebuild or transfer the bases. So if you have a permanently disabled situation or a disaster relief, wildfire, flood, or whatnot, call our office. We'll talk to you about that. Today, we're going to concentrate on the parent to child and the senior exclusion. That's going to take care of 99% of your issues. The current rules for the parent to child, grandparent to child are, and this is important because these rules are going to change and you want to know whether you want to take advantage of these rules. On your primary residence, you can transfer an unlimited amount of assessed value. So for example, if you bought your place for $50,000 and you're only paying based on $100,000 of assessed value or $1,000 a year, and your property is worth $20 million, well, let's say 2 million because it's easier for me to calculate. If it was 2 million, then you would pay $20,000 or a $19,000 difference. Unlimited transfer. Don't worry about it. What the value is, you can transfer it all, no issue. Also, right now, your kids aren't required to live in the property. Third, you get an additional value of $1 million of assessed value on all non-primary residential properties. So you can imagine if you have a second condo, you have a vacation home in California, you have a gas station that you bought, it doesn't have to be your home, you get up to $1 million or 10,000 worth of assessed value to transfer over. Okay? So we're going to see what that looks like in an example. Imagine you bought a home in La Jolla in $100,000 in 1980. Your current assessed value estimated would be $160,000, right? I'm just going to run my numbers here. That yes. Okay. So if your property taxes are $160,000 assessed value, that means you're paying actually $1,600 in taxes. The market value on the property is $2 million. And this happens. If you bought a home in the 80s, you could have a $2 million property today. And we see that. If the market value is $2 million and you gave that to your kids and they had no protection, they would pay $20,000 in taxes at that point. Now you can give them unlimited or that $160,000 or $1,600. You're going to be saving your kids on that transfer $18,400 annually. They'll pay the same taxes that you do and not pay that increase of what would be $18,400 annually. That's currently on the primary residence. In addition, remember you get that $1 million extra on other property. If you had a lot that you bought, commercial lot for 500,000, or you'd be paying 5,000 in taxes, and it's worth $1 million, if they went to pay the full on the $1 million, they'd be paying 10,000. But because you could give them 500,000, they save $5,000 a year. Same thing on a condo. If you bought a condo for 500,000 and it went to $1 million in value, if you gave them your low tax rate, you'd be saving them $5,000 a year. That is allowed right now until February 15th. That's the key date. Now, February 15th is a holiday, so don't wait until February 15th. I just gave you some insider information. I looked at the calendar for you. Make sure you do this before February 15th. After February 15th, because of Prop 19, now you can only give up to $1 million of assessed value on the primary residence. Remember, you could give unlimited now up until February 15th. After February 15th, you're limited at $1 million. You must live in the property, so your kids have to move into the property and have it as their primary residence. You also have to file within 1 year a homeowner's exemption or a disabled veterans exemption, versus you get 3 years under the current rules. That's what changes after February 15th. So for example, we're going back to that La Jolla residence where you're paying $1,600 a year in taxes. If you didn't have that exemption and you do it after February 15th on that same property, you're now going to have an additional amount added. That difference between that $1 million plus the 160,000. So that's 1160 minus 2 million. 840,000 is their new assessed value, or $8,400. That's a $6,800 annual tax increase. And that doesn't include bonds and indebtedness. And as your assessed value goes up, so does your bond payments. So right now, basic calculation, they're going to have a tax bill of $8,400 versus $1,600. That's what happens after February 15th. Remember that additional property, right? Maybe an extra sorting parcel that's a commercial use for your farm, or if anybody's a egg farmer, you got the hen house, right? That would be other property. You don't get that under Prop 19. It all goes away. Even the vacation home, or in some cases, people bought a second home so their kids can live nearby. You can give them that second home now. After February 15th, that benefit goes away. So Prop 19 rules, this is what it looks like. You have a home that you buy for $300,000 in University City in 1990. You paid $300,000. Over time, the taxes went up to a $420,000 assessed value, or $4,200 in taxes. Because that $1 million plus $420,000 is less than what you paid, your kids get to keep the same taxes. They pay $4,200 versus having paid $13,000 based on 1.3 million. So that's a big savings for them. But remember, they have to live in the primary residence, and if you move out or rent it, we assume that you're going to lose that benefit. So here's something special for the family farmers. I want to give a big shout out to the California Farm Bureau. They did a really good job advocating for farmers. You're the only folks that got a carve out in the initiative legislation, and they made sure that if it passed, you're taken care of. So it has to be a family farm. If you are an LLC, are you a family farm? No, it has to be you as an individual that owns it. But tip right here, you can move a property. If you as husband and wife put your farm into an LLC, you can pull it back out, transfer it to your kids, and then put it back in the LLC. Call us with your specific questions before you make that transfer. We want to make sure and let you know in writing, because if it doesn't come from government in writing, it doesn't count. We want to make sure that you're not going to get reassessed unnecessarily. So for farmers specifically, you get a primary residence benefit. Now, instead of having unlimited, you get $1 million of assessed value. But remember, they have to live in the property. It has to be their primary residence, and they have to file within 1 year the homeowner's exemption versus the 3 years. Second, for farmers, and only for farmers and the family farm, you're going to get additional $1 million of assessed value on all qualified family farm property. And the state of California actually has a definition for family farm. but it has to be in your ownership, not in an LLC at the time of transfer. So for example, if you had a farm that you paid $250,000 for, and its assessed value today is 500,000, but the farm's worth 10 million, you get to give them that value without the farm getting reassessed at the 10 million or $100,000 annual taxes. They'll continue to pay that low amount that you bought it for of $5,000 in taxes. So that's a significant amount of savings for the family farm. So a market value of $30 million is $300,000 on an annual tax bill. If you transfer before February 15th, insider tip, you can transfer your primary residence. You'll get that same benefit after February 15th, but they have to move into it. Second, right now, you have other property that you can transfer. We believe if farmers transfer their other property, so let's say you have something that's part of the family farm, but is not considered farm use, right? You have a sorting facility that we don't think would qualify as a family farm property parcel. We can transfer that over now under the $1 million of assessed value, and then after February 15th, you're going to get the additional $1 million of assessed value on the family farm portion. That is areas that are used for growing, farming, kind of like you see the cattle right there, that would all be a qualified use. So farmers that take advantage of the pre-transfer of 215 and then take advantage of the California Farm Bureau getting them an additional $1 million after for their farm property can essentially get $3 million of assessed value that they can transfer to their kids. We are knowing that this is a very complicated topic, and we're going to welcome phone calls afterwards, emails with specific questions. We want to get you the right answer on your property and not have you guessing. Okay? The other thing is, again, I cannot state this enough, the transfer of 215 is important. Now, remember I told you our recording is through the roof right now? We're doing record high recording. The deal is you don't have to necessarily record. It is the strongest way to prove that you did it before February 15th. But if you notarize and deliver that property, so if you deed something to your kids and you deliver it and notarize before February 15th, that is the second strongest way to do it. Now, you could always just handwrite something and deliver it to your kids on February 15th. We're going to need additional proof associated with that. So I highly recommend notarize and deliver if you're going to do this. The second thing is there's a lot of ways that this is going to impact you financially. There's IRS implications. I'm not an IRS commissioner. I'm not an IRS guy. I work for the property taxes, and I'm talking to you about property taxes. So there are things called step up in basis. When one of the parents die, the property gets relief from income tax, from capital gains tax. You need to talk to your IRS professional and make sure that if you do give your kids the property, there's ways to sell to them that will help you with your IRS potential liability, and at the same time get you the benefits from the property taxes that we're talking about today. So this is a two-part deal. It's not a silo. I will say for us as presenters, it's a silo. For you as a homeowner, as a business owner, you need to talk to your CPA and make sure you're sorted out with the estate tax, with the step up in basis, and in addition with the capital gains issues. So some folks may want to sell their kids the property and then forgive the note afterwards. There are ways to do it that will allow you to take advantage of all of it, but you need to start planning now. Okay, for the senior transfer portion. Now this is for some of you that are like, well, I have the family farm. I'm gonna leave that part to the kids, but I'm gonna keep the primary residence. Right now, the rule is, if you're over 55, you get one time to transfer that low basis of a primary residence, and it has to be under the current formula cap, which is your sale price plus 5% the first year or 10% the second year. You have to file for it within 2 years, and it's in the same county or in one of the counties that has adopted the desire to do it. And there's only 11 that do it as of today. After April 1st, that's going to go away. After April 1st, this is the expanded senior benefit. If you're over 55, at least one person in the couple, 3 times now, not one, but 3 times you get to transfer your bases. It still has to be your primary residence. And now there's no longer a cap on the deal to stop you from doing it, but there's a cap. And then we start to add things at market rate. You still have to file within 2 years, and it's statewide now. So if you're like, hey, my grandkids are in Sonoma County, if you want to move up, doesn't matter what county it is, Nevada County, some of these other counties that weren't doing it today will have to do it come April 1st. One of the other questions I get is, let's say I already sold my primary residence, but I'm waiting to buy a new place, and it's more expensive than when I sold it, plus that 5%. If you complete the transaction after April 1st, we believe you will qualify, and we will look to honor that for a full transaction to qualify you. Okay? Second, if you give your kids your basis, right, you do the parent to child transfer, you can't get the senior transfer afterwards. But you can do the senior transfer and then give your kids the parent to child transfer, okay? So that's just something to keep in mind as far as order of things. All right, so here's an example for the after April 1st. You bought a home in 2000 for $300,000. 20 years later, your assessed value is $420,000 or $4,200 a year in taxes, and you sold that place for $1 million. Then you go and buy your replacement property for $900,000. Your taxes would be $9,000 if you bought it at the market rate, but because you get to transfer over your lower basis and it's below the cap, you get to transfer over the $4,200 instead of $9,000, and you're going to save $4,800 a year. The second, in this scenario, oops, I apologize. What if you go above the cap? So you have that same property, the same low taxes, but now you're buying a place more than $1 million. That's what you sold it for. Your taxes would have been $12,000 had you bought this replacement property for $1.2 million. But because there's no cap now, what we do is we deduct $1 million, your sale price, minus your purchase price, and that difference is added on to your old taxes. So you still get a benefit. So your old taxes would have been $4,200, and you add $2,000, it would have been $6,400. That's what the new taxes are, and that's going to be the savings. It's going to be $5,600. Okay.
Jordan, one more question.
Yes.
Those caps, are they
Yes.
fixed, or will those adjust up over the years?
No, the cap after April 1st is fixed to your sale price.
The $1 million.
Okay, so I use just $1 million as an example. Okay, so
I get it.
we're going back to the parent-child. The parent-child is $1 million, and we think it's going to be factored. They're working out how they're going to figure that out right now. So it's going to increase, but honestly, it's not going to increase with the rapid rate of the market. It might be some sort of small increase like we see in Prop 13. And the reason we know that is the disabled veterans exemption goes up annually. They look to pick different markers that they already have established, and they don't go up substantially. So I think you're really working with that $1 million number as the operative number for a long time.
It won't be linked to inflation.
It will, but the inflationary factor that they're choosing hasn't been decided yet. And quite honestly, it's going to be de minimis.
Okay.
Yeah, so again, I would just run the numbers based on $1 million. So do we have any questions? Let's go questions on the parent-child. Otherwise, I got a couple of other things, and then we can circle back for more questions at the end. Okay, one thing I want to make sure I'm talking to you today also and saving you money is some of you have bought properties after 2015, made improvements after 2015, and COVID hit in March of last year. We could not start providing relief until after this year. And the reason why is January 1st is what the lien date is set by the state. So because COVID hit in March and the lien date was January 1st, it happened afterwards. That's the day that we assess your properties. This year, January 1st, COVID's still ongoing. So now we can account for COVID COVID loss of value. Remember that Prop 8, we can drop down your taxes. We are making the assumption based on our research that if you bought your property after 2015, you're likely to get a relief from COVID. If you bought your property in 1980 and you're paying a really low property tax, I'm sorry, there's not a likely a chance that we're going to lower it enough to meet that number. And you don't really want us to be in that position. You like that high value on your property. But if you made improvements, if you bought your property after the 15th, 2015, we think that you're going to qualify for a Prop 8 reduction. Talk to us. We have up until April 30th to lower your values informally. And then afterwards, you have to start going through a formal process. We want to be here to give you relief if it's possible. The second, that homeowner's exemption for the parent-child that you're going to be required to file, we're the only county in the state of California to offer it online. So if you go to sdarcc.com, by the way, if you have a home and you're not getting this right now, remember on that tax bill I showed you where it said 7,000 minus. If you don't have a 7,000 minus on your property tax bill for your home residence, file it and let us save you 70 bucks a day. Here's Ernie with the mayor of Lemon Grove. And you can see where that arrow is pointing, where to look on your, should say homeowners. She did not have it on her property. Ernie sat down and online and filled it out, and boom, we got her homeowner's exemption. She's been probably saved almost $400 since she filled that out. So who doesn't like money? Second, there's two types of homeowners exemptions in California. One, the basic one for your primary residence, but also if you're not claiming that one, it's because you're probably a disabled veteran. Disabled veterans get an exemption on their primary residence if they were veteran approved, VA 100% disabled or unemployable. We can save them money on their primary residence up to $2,000 if they have a low income portion where their family makes less than $60,000. This young man right here, he didn't file for 8 years, and we were able to go back 8 years on his refund and get him $10,000 back from the county. So if you know a veteran, by the way, it really improved our process. If somebody's like, I appealed, I already went through the process, because your rating gets a little worse over time, right? As you get older, things get a little harder. We have helped over a dozen veterans appeal their VA rating and qualify. And not only do they get a break on their property taxes, but they get like $3,000 a month and other benefits. Also, it's not just for the veteran, but it's for their surviving spouses. So those Gold Star families, if there's somebody that you think we could be saving money, we want to be doing it. We launched a campaign in 2018 when I started as part of my office. We were really proud. We went from 5,000 to 8,000 veterans. It's amazing this year. We are at, and I apologize, I thought I had another slide there. We are at over 11,000 veterans as of today. And so in 3 years, we've been able to create an outreach program, putting over $10 million back annually more into the hands of disabled veterans here in San Diego County. So we're really proud about that. I know I'm going to go into questions. Here's my information again. I know Katie was kind enough to drop my information in the chat box. And if you want to reach the boss himself, there's his email right there. And I'm going to answer questions and take scenarios, and we're going to have a little bit of fun right now. So, all right. Any questions you ever wanted to ask your neighborhood-friendly county assessor office without getting reassessed or giving your home address? All right. If we don't have any questions, I just want to remind everybody of the big takeaway is if you're a farmer and you transfer $1 million of other property to your kids now, you can get an additional $1 million after April 15th for farmland. Okay? And each parent gets $1 million that they get to give their kids. So make sure you're maximizing transferring those low tax bases to your family because it makes it more affordable to operate here in California. Oh, and before we leave, I just wanted to introduce a special guest who wanted to say hi. He's at the state advocating for you and making sure the family farm is treated right. Fellow farmer Ernie Dronenburg.
Hi there, gang. I got my John Deere tractor all worked up. I've got one of the small ones for my grandkids. And for Christmas, it was all operational. So Jordan has been working with you on the Prop 19 issue. And hopefully he's answered all your questions. I've been meeting with the Board of Equalization, working on the details of the legislation that we hope to have passed and in place by mid-February. And then more legislation set to go before April 1. But they really put some tight deadlines in the proposition. And we're running hard to get it passed before the deadline comes and you need information to make a decision.
So at the very least, we want you to know you have a partnership here with the assessor's office. Call us with your questions, talk to us early. You have about 30 days to really get this in order to take advantage of transferring as much of it as you can, because those family farms that have been around for years have low tax bases, and that right now during COVID, and particularly in the state of California, we know every dollar counts to make sure that your small business and your family farm is winning. So any other questions out there?
Jordan, I have a question.
Okay, we're going to go with this young lady first, and then we're going to go to the gentleman afterwards.
I have a question outside of Proposition 19. What is happening with the Williamson Act, the Ag Preserve?
So
There's nothing going on the Williamson Act. We had some legislation last year that died on the vine, but we see nobody this year that's got anything in the hopper. This year, the legislature is going to be really limited on the number of bills that can be carried for each legislator. So there's going to be a high priority put on legislation. And unfortunately, the Williamson Act, I don't know if it's going to make that threshold. It's more about COVID, it's more about finance, it's more about education this year.
great question. And we are watching whether 19 will impact the Williamson Act in any way, but we haven't seen anything particularly on point.
Thank
Okay,
you.
next question.
I was hoping we could go back and ask a little bit. You had mentioned about the family farm cutout and the farm could not be owned by an LLC. I just wanted, get into a little bit of specifics. If the property itself is deeded in a trust, but there is an LLC that's farming the property based on a lease agreement, is it considered a farm or is that just considered personal property?
Great question. So if the LLC has a lease, then that lease would not be impacted. It would be the trust property that would be transferred over. A trust is a way.
But as a farm or as an investment property?
So it depends. Again, we're talking, assuming that you're a qualified farm. For the primary residence on that property, we would section off the primary portion, or in some cases, people may want to split their property and legally segregate their property to separate out the primary residence. But on the family farm portion, as long as the lease, and again, there's a couple of nuanced rules. If your lease from the LLC is longer than 35 years, or an option longer than 35 years, we're going to assume the LLC owns the property. But assuming that they don't have that, the trust is a holding vehicle for a real estate. It would be belonging to the beneficiary, so we'll assume that's the parents, and they can transfer that to the kids without issue. So just in general, if you have an LLC that rents the land, it should not impact their ability to transfer that down.
And could you clarify what you mean by sectioning off the primary residence? Are you talking about actually getting a new parcel number, going through PDS and doing the EIR and everything? Or are you?
No, you would not need to go through PDS and EIR. You would file for a segregation with our office and our mapping department, and you would be assigned a different parcel number, yes. So Del, it's a very easy process to do, but because the legislation specifically assigns a benefit for the primary residence and a benefit for the commercially or the farmland, to get the maximized benefit, a very easy filing with our office can get you there and save you up to $10,000 a year in property taxes on that extra property.
Okay, I'll send you an email. I have a non-related follow-up question then. Thank you, Jordan.
Great question, Del. And remember, as I told you, if the property is in an LLC and you're owned as husband and wife, or you own it as an individual, you can transfer it out of the LLC to you as the primary owner. You will not be reassessed. Transfer it down to your kids and have them put it back in a new LLC. So if you have questions or scenarios, we will go through all of them with you and make sure that you're not going to get reassessed and you're taken care of. Our goal is to help you be as successful maximizing this benefit. But after February 15th on the primary residence, your kids have to live in it. They can't rent it out. Second, what if you have a barn that you've been renting out for a wedding venue or whatnot? That's other property you could be transferring now, that portion, and then get an additional $1 million of assessed value after February 15th for farmland. Okay? So make sure you're doing your strategic planning and saving your family farm as much as possible. Mel, did you have any questions? All right. Sandy, used to work in the office. Any questions?
No. Good luck.
Oh, yes.
Thanks.
And remember, with fictitious business names, in order to get COVID relief, birth certificates, death certificates, other documents that you need that are vital to your business, call me, call us. We're here to make sure you get what you need. So that way you could be going as quickly as possible and not be interrupted by COVID. Okay? Katie, anything else besides our much appreciation for you, Hannah Bay, and the entire Farm Bureau Board, including members like Ernie Dronenburg?
Yeah, no, you covered so much valuable information and we really appreciate it. And I appreciate you taking your time to speak with us and our members.
Want to say something, Ernie, on the way out?
Good luck.
And we're here to help you as a resource. Again, Katie put my information in the chat. And, honestly, I've been really blessed to work for Ernie. He knows how hard it is to run a business here in California. If there's anywhere in the county government, the state, anything that you need help with that we could be a resource, call me. I want to keep you off the 800 numbers because they're even busier than they were before. And we're going to get you direct assistance, okay? All right. Happy 2021, everybody. Thank you for the opportunity.
Best of luck.
Thank you.